Hello and welcome to It's Not Your Parents' Basement, the Denver metro area's only first-time homebuyer show. My name's Olivia Konovicius.
I'm Christian Durland.
And today we are here to talk to you about the difference between FHA and conventional loans. Now, of course, you're wondering, what is that? Most first-time buyers really get confused by this question. So Christian, our lender expert, is going to explain the differences.
So just to try to bullet point the main differences, first off, both loans are technically available to first-time homebuyers. So that's a misnomer. Sometimes first-time homebuyers think all that they could qualify for is an FHA loan. So need to dispel that myth quickly. But FHA is typically where you're going to fall into the FHA bucket is if you have lower credit scores, anywhere from the low 600s to the high 600s. You have recent derogatory credit events such as a bankruptcy a couple of years ago, a foreclosure a few years ago, short sale, things like that.
And even maybe a 30-day late payment on a credit card, is that correct?
It could, because that's going to send your credit score down. And why that's important is that FHA mortgage interest rates stay the same across the board pretty much. So if you have the lowest credit score they allow or the highest credit score that they allow, your interest rate's not going to be affected all that much. So that's why somebody who maybe has some recent credit issues, ends up having to use an FHA loan when they might have qualified for a conventional. Now, conventional mortgages, it's a little more tight. Again, with FHA, you're only required to come up with a 3.5% down payment. Right now, conventional requires a 5% down payment, but I will say this, we're hearing that in a very short time, conventional might return the 3% down.
Wow.
So they might be even again, we'll see. But at this point, you need at least a 5% down payment for conventional. And you need what we call payment reserves, meaning you put down 5%, you still need to have some money left over in your bank account, savings account, 401k, retirement, for at least 2 months of your future mortgage payments in reserve. So that's sometimes one of those little rules that somebody thought, oh, I can do a conventional, I got a 5% down payment, but then they get put into the FHA bucket because of that. So other than that, those are the main differences. And then, of course, as we'll talk about more, mortgage insurance. So.
And that's something that most people have heard about, but they also have no idea what that actually refers to. Is there a difference on mortgage insurance between going FHA and conventional?
There is. FHA, it's kind of become a bad word, but it's the socialistic loan, meaning, everybody who uses FHA loan has to pay into the system, if you will. So whether you have the best credit, a high 700 credit score or low 600 credit score, you're going to pay the same amount of mortgage insurance. And what that does is it makes FHA solvent. It gives the government the ability to back these loans and keep the program around so that people can use them to buy their first home and that kind of thing. Now, conventional mortgage insurance is handled by private mortgage insurance companies. That's why it's called PMI.
Because conventional loans are not backed by the government.
They're not backed by
correct?
the government. So these private mortgage insurance companies come in, and that cost of mortgage insurance is very sensitive to credit score, how much money you're putting down. There's a lot more tiers on the conventional side of lending. So, and the same with interest rates on the conventional side of lending. That is why if you have lower credit scores with conventional mortgages, a lot of times people opt for the FHA option because it ends up being a lower cost because they have lower credit scores. Because on the conventional side, they're going to charge you more in mortgage insurance and for the interest rate with lower credit scores.
Well, this leads us to an example, just so we can get you a little bit of clarity. I'll pretend that I'm the buyer. I'm looking at buying a $200,000 home. I've got credit in the 700s, and I have a 5% down payment. But that's all I have, just that 5% in my savings account. So what would you say? Should I go FHA or conventional?
Well, I would tell you first, you do have the choice. I'd say, okay, it looks like you can pull off a conventional loan, but since all you have is the 5% down payment and you don't have the payment reserves, the 2 months payment reserves, let's say the payment on that would be $1,500, you need to have $3,000 above and beyond your 5% down payment. Now,
and I don't have that.
You don't have that. So if we exhaust all options, I ask you, well, can mom and dad give you the $3,000 as a gift? Or
I wish, but they said no.
Is there enough in your 401k as far as a vested balance? No?
I don't have a 401k.
Okay, well, then, unfortunately, Olivia, well, I shouldn't say unfortunately, but you'll have to use an FHA loan.
Okay.
And what you get then, what I would tell you at that point is, well, great, you have the 5% down payment. Now all you have to do is put 3.5% down. You will get a lower rate. Your payment might be slightly higher because of the mortgage insurance. So it's not ideal, but at the end of the day, you can get the mortgage, you can buy the home, and then we look to refinance you possibly in a couple of years into the better conventional loan.
And looking at things from a larger perspective, I'm excited because now at least I can purchase a home and I'm not paying rent.
Right.
Because let's say I was paying $1,800 to rent a house, now I can buy a house and have a lower payment.
Right, exactly. And maybe you didn't have it as low as you could have had if you used the conventional loan, but at the end of the day, you have a little money left over because you didn't have to put 5% down. You have a lower interest rate. You know, there is some, you know, there's disadvantages and advantages to both. But the important thing, I think, the moral of the story here is work with a loan officer and a lender and a realtor who know the differences and who are going to give you those choices and who are going to make an effort to get you the best loan.
Because clearly there are a lot of details and you really do need a lender who's going to walk you through each scenario so you can make the best decision for yourself.
And give you that choice. Can you go to mom and dad or find another way to get that payment reserve in our example? So
we hope this has shed some light on this topic so you have at least a little more information when you do start that process. So thanks so much for joining us today.
Until next time, remember you can download our ebook up here, The Yellow Brick Road to Home Ownership. We have a place to place your comments below, ask questions, share the knowledge, share the video, save it. And until next time,
always remember,
you'll never forget your first time, not next time.
Thanks.
Bye.